systematic base. This review is done periodically, maybe quarterly, maybe half yearly, maybe yearly at the end of the year. But this review would be helpful for the managers to take a further decisions, enhancement of the business, development of the business, and if any policy has not been accurate work in the business, how it could be accurate or how it can be revised, changed. So this definition has been given by AICA, American Institute of Certified Public Accounts. It reflects a combination of recorded facts, accounting conventions, personal judgment, and the judgment are understood according to the require of materiality. So this is the way of the concern of nature. This makes it clear that data exhibited in financial statements are result of the combined effects of one, that is recorded facts, that is basic requirement. Second, accounting convention. So whatever the data has been recorded, it is recorded only on the basis of facts. The second, it is recorded in the books of accounts on the basis of accounting principle and conventions. And the third is, it is recorded sometimes on the basis of accounted judgment. That means the account who is going to write an accounts, according to his judgment, which method, which system is suitable for the company would be applied. Let's begin with the first point, recorded facts. The term recorded facts refers to a situation where the data used for preparing financial statements are drawn from the accounting records. It means that whoever is accountant is identified the monetary transactions, identified the situations, and it would be recorded in the accounts, and that has to be passed out to the person who is preparing the financial statements. For an example, figures relating to a cash in hand at the bank, debtors, bills receivables, assets valuations, depreciation consideration, creditors, etc. These all the informations, whatever occurred in the dates or during the dates or during the period should be considered. That means only facts to be considered. But sometimes financial statements do not contain those facts that are not recorded in the books of accounts. In such a way, these are the important things. Whether it is actually not recorded or recorded, it's a secondary thing. But the facts are facts. So some facts which are not recorded in the books of accounts, which are also required, like original cost of fixed assets, depreciation, which method would be applied on the fixed assets, investments are given on the market value or as a book value. So these informations are actually concerned of facts, but it is not at all considered in the books of accounts. Therefore, be clear that the balance sheet does not show the financial positions of the business in terms of current economic condition, because most of the items which is exhibits are shown as recorded cost, which are only historical cost rather than the current cost. That means whatever the things are happened, whatever it is applied, it is recorded on the basis of a historical cost instead of the practical cost. It may, however, be noted that in effort to make this statement more meaningful, some facts which cannot be recorded in the books are shown considered as a footnote. So it may be, if it is compulsory to be recorded in the books of accounts, whether it is a facts or whether it's a monetary facts or a non-monetary facts, but it is to be recorded in schedules or in a balance sheet or in a income statements as a footnote, like the market value of investment method, which is to be recorded into bracket in the investments. This is the market value. In case of stock, which method was applied to record, whether it's a LIFO, FIFO or any other method. As in contingent liability, we are always supposed to be recorded a contingent liability at the end of the balance sheet. So these are the informations to be considered. Second point, accounting conventions. Fine, all accounts are always recorded on the basis of concept, conventions and conservatism. Why? Because of these are the basic principles to write an accounts. If accountant does not know these principles, then it would be very difficult to take a judgment and analysis of the financial statements. The term accounting convention refers to certain assumptions and procedures used In accounting, different assumptions are made to implement the accounting conventions related to assets valuations, amortization and income determination. It is assumed for statement purposes that 1. The business will continue as a going concern. Second, revenue and cost will be matched for specified short-term time interval, usually in a year. So that means revenue and cost is always to be taken as per the particular duration. Whatever the duration has been decided, the revenue as well as the cost to be considered. So whenever you are going to do the transactions, the purchasing power of the currency remains same. Now the third point, that is the personal judgment. Personal judgment is a combination of first two. First is recorded facts and the second is what? Conventions. So it is a combination of recorded facts and convention of the financial statements. For an example, accountant decides 1. Whether to charge depreciation on a straight line method or a written down method. So that means who is going to decide it? The person who is going to write an account. It's a personal judgment. Second, write off intangible value in a 1 year, 2 year, 5 year, 10 years. Who will decide? The person who is writing accounts. He may be having an idea this intangible assets can be utilized for a number of years, or it may be taking an advantage or benefits of how many number of years. So on that basis, it would be taking a decision. Another thing is to follow a LIFO method or a FIFO method for valuing a stock in trade. So there are many methods to record a stock, but which method is suitable here? That they has to take a decision by individual or a person who is writing an account. To provide a reserve for bad debts, whether it is a 2%, 5%, 10%, it is also to be decided by the individuals. Why? Because he knows this person may not be considered, or this person may be a doubtful, or the last year was not a normal year, maybe because of the many issues, people may not be paid all the amount. So the bad debt reserve has been designed on the basis of certain criteria. Now the another thing is to record certain expenditures as a capital expenditure or a revenue expenditure. It is also to be decided by a person. So here it's all about a part of this particular concern. But the next point is purpose of financial statements. There are many purposes to analyze the financial statements. The purposes which are required for the better prospects of the company, development of the company, analyze the company's situations at present and what could be the best things for doing a company. Here, to comply with the provisions of a Companies Act, that is the main purpose of financial statement, because of according to the Companies Act, financial statement analysis is must. To be used only for income tax purposes. That means the income tax department and authority willing to know that how much amount of the tax are liable to pay at the particular intervals. And that is why the analysis of financial statement is required. To provide requisite information to the shareholders who are actually your major investors in your company, then the savings who had been actually given in your company, the lenders of money like bankers, creditors and other people, as well as the trade people who are actually giving finances to your company. They are also willing to know the analysis of financial statements, the another purpose. To put forward a true picture of performance and financial position to the bank for obtaining a loan. That means the people who are willing to take a loan, especially organizations are willing to take a loan, they wanted to know that, and they are preparing financial statements to getting a loan easily from the bank. To suit the requirements of stock exchanges and controller of capital issues. That means the registrar who are actually always asking, they need to submit their financial statement analysis regularly to them. To bring about the personal contacts among the workers, concerned parties and the management. So these are the people who are actually willing to know the company's status, progress, advancements and the future prospects, what they wanted to do, it will happen to understand through the analysis of financial statements. So these are the parties which are very much keen to know the analysis of financial statements and to assist the management in forming social policy decisions such as pricing and other concern. This is a purpose of financial statements. Now moving to the next point, that is types of financial statements. If you are going to classify the types of financial statements, broadly two classifications are done. One is on the basis of a material used and the another one is on the basis of a modus operandi. Material use means the informations which are actually collecting from the different resources to analyze the financial statements. Material means the sources of information. There are two sources, two possibilities. One is an external analysis, the second is internal analysis. And another part of the classification is a modus operandi. There are also two major classifications. One is a horizontal analysis and the second is vertical analysis. We'll start with the first analysis. Before that, I just want to explain what type of financial analysis can be required. Financial statements are analyzed by the users to establish a certain crucial relation which help them take sound decisions by making a comparisons. So in case of the comparisons between the analysis, it has happened that how the company is having a soundness and how the decisions are more accurate and effective according to the concern. Example, management may analyze the profitability of the business enterprises over a period of time so as to determine the trend of profit and take policy decision based on profitability trends. So very simple logic is, if the companies analyze the profitability trends, they might be analyzed of the profit for the past years. That's one thing. They can compare their profit with the number of years also. Then they can compare their profit with the same type of company also. Maybe they compare their profitability with the same segment and same sectors also, and also many more. They maybe compare the profitability as well as the informations which are actually standardized. That means the standard has been designed by the company and their standards with the compared with the actual results. So these are the possible concerns. Similarly, a prospective investors may analyze the profitability of two or more business enterprises to determine the appropriate possibilities for the profitability. Now let's begin with the analysis or types of analysis. Here we will discuss the analysis of financial statements one by one, all the methods. Start with this first, intra-firm analysis. It is a comparison of financial variables of a business enterprises over a period of time. It means the comparisons of financial variables inside the business. It is very useful to management to take a various policy decision. That means the company will compare their data, find out the outcomes, and their outcomes will be used to take a future policy. And for how the policy can run, what are the drawbacks, what are the loopholes in that part, and that solution can be implemented for the future path of action. It is known as time series analysis or a trend analysis. The trend analysis shows the reflections of the past number of years data. Here, the outsiders included creditors, suppliers, investors, governments, agencies, and many more are also concerned with this intra-firm analysis. These parties do not have access to the internal records of the concern and generally obtain data for analysis from the published financial statement. That means those are published financial data will be analyzed in such a way to consider the internal records, and such an analysis serves a very limited purpose. Thus, analysis done by outsiders is known as external analysis. Now we'll move for the next analysis, that is inter-firm analysis. It is a comparison between two or more business enterprises. The basic foundation or basic requirement for this comparison is any particular such type of business or same type of business doing company statistical data or an information would be compared with our company's data. or with the sample company's data. So that means the two or more companies information, statistical information or an informations would be compared and find out the outcomes. It analyzes and compares financial variables of two or more concerns to determine the comparative strength and weakness of these enterprises. So on the basis of that comparisons, they will find out how the company would go further, what is their strength, what are their weaknesses, what are the opportunities to be improvement, and how it runs in a different policy. When single set of statement of two enterprises are compared, it is known as cross-section analysis. So any particular comparison, it could be considered as a cross-section analysis. Sometimes financial statements of two or more enterprises are compared over a number of years. That means not compared only for 1 year or maybe a 2 year, but they might be compared for 5 to 7 years. And as per their comparisons, they would do identify the cross-sectional trend analysis. The cross-sectional trend analysis means what? First, they will identify the number of years of the one company, their trends, and then find out the another company's number of years trend, and their trend would be comparisons. So the comparative cross connection or cross sectional trend analysis, it's very important here, the part of analysis. This is an analysis done on the basis of information obtained from internal and unpublished records and books. So there are many possibilities or many informations which may not be published in the books, available directly, may be compared here or may be taken as a knowledge to analyze the further things. Such an analysis serves meaningful purpose of internal management as well as employees. Next comparison is industry average or standard analysis. I want to tell you, industry average and standard analysis is always based on the standard has been designed by either a sector or an industry or a segment, or maybe the standard has been designed by the company itself only. So whatever the standard has been designed by the industry or a company, they will compare their present data or actual data with their standards. So here the time series analysis involves analysis of number of financial statement of a different accounting years of a business enterprise. Cross-sectional analysis involves analysis of financial statement of business enterprises for the same period, maybe 1 year. The same thing they would be compared, the 1 year comparisons of the financial data, and then they will find out the outcome of that. There is a third type of financial statement analysis which involves an analysis of statement of an accounting year of a business enterprises. So third concern is the analysis of financial statement according to the requirement. Only one set of financial statement of a business enterprise is analyzed, and financial relations based on this statement are compared with the standard set for the firm or industry. So that means the standard has been already decided, either maybe for a company or maybe designed for an industry. For an example, actual profitability are revealed by the analysis of financial statements may be compared with the normal expectations in that industry. So it may be sometime happened, the gross profit margin has been designed for an industry maybe 30%, and then the company has actually maybe reached to 25% or maybe 35%. According to that percentage, compare with the standard data or an average data, you can take your charge, or you can take it always your decision. Next is horizontal analysis. It refers to an analysis of change in related items in comparative statement. That means there